so there is some homework that will be left over. Before I continue, I see there is a hand. You can ask your questions.
Hi, sir. How are you?
Good on yourself.
I'm good, thank you, man. Just wanted to ask you, when are you gonna upload the rest of the slides?
I posted an announcement more or less at 5. So hopefully it's already visible or sent out.
Oh, is it? Okay, because I was
Yes.
there earlier on. I didn't see anything actually, so hence the question.
Maybe while we are busy with the introductions, if somebody can just confirm if they are able to go on and to see the announcement. Let's just check from my side, because I know normally they might also, they allow for a 30-minute posting delay. So
Oh, is it?
like cancel backup type of thing. If you maybe get sender's remorse by posting something that you later feel you shouldn't. But yeah, then the 30 minutes should hopefully be more or less done by now.
Okay. Tell me,
So maybe,
would it be
yes?
under the announcements 6 May one?
Yes, it's one that yes, I posted it, like I said, about 30 minutes ago.
Is it? I don't see it on my side, but I'll check during the course of the lecture and let you know.
Okay, great. I'll appreciate that. Thank
All right,
you.
thanks so much.
Okay, yes, and I think the last thing I said was with regards to the slides. So you'll see there is some bit of homework. Let me first then start with the purpose of this class. I corrected the test 2 information. Thank you for Monday's comment in that regard as well. The class is now recorded. Please participate, ask your questions. And then you'll see if I move to the topics. I've just actually moved it a bit around compared to the list in the learning unit. So I thought IFRS 3 is quite big. IFRS 15 is quite large as well. So I'm going to start with IAS 10, sort of as an easy icebreaker for this evening. And then after IFRS 3, it's going to be IAS 37. And then to finish with IFRS 13. But depending on the speed that we go to, there's a fine line between just ensuring that we cover everything versus actually adequately covering it. And it's a quality lecture as well. So IFRS 13 is last. I must say it's not to say that it's the least important, but from my consultations that I've already had with some of the students, it's sort of the standard of all the list of topics that students struggle the least with. So that's my thinking with regards to placing it last. So hopefully there's no signaling effect that you see in any of the placements or just the shifting of the order. So let's start this evening. Let's start. It's hopefully fairly good, and then we can end with excellent and success by the end of the session. And that one comment in the chat that says Consult is making me question it, that it's actually going to be a positive comment after test 2 as well. So let's jump right in. So the first one is the events after reporting date, IAS 10. So of course, the same principle is applied where we first go and look at the proficiency levels, and we can see good or bad for us. Everything is at level 3, so we know, okay, we need to have a very good overview and understanding of the standard. And then you can see the standards, it's sort of nice, short and concise, the objective scope, and then delving right in with regards to the adjusting events, non-adjusting events, dividends, going concern, and then how to disclose for the relevant items. So you'll see there's two specific distinctions that should be made. The first one is the adjusting events. Those are events that provide evidence of a condition or event or issue that existed at the end of the reporting period. And non-adjusting events, of course, is the opposite. It's events that are indicative of conditions that arose after the reporting period. And it's just important to note that those events can be sort of good and bad, favorable or unfavorable. And then they also provide specific guidance with regards to dividends, that dividends proposed or declared after the reporting period, but before the financial statements are authorized, of course, will not be disclosed as a liability, because you can ask yourself, did it exist at year end? And no, it did not. That decision to declare happened subsequently. But then in terms of IFRS 18, 132, we will just disclose it in the notes that yes, it is disclosed or declared. The other option, of course, is with regards to a going concern. If the going concern assessment was made or it trades after the financial statements have been issued, of course, then the financial statements are issued. But if it does change your assessment between when it was sort of the year end and when it's finalized, then you would, of course, still adjust the financial statements then with that assessment because it is so material. And then there's actually a key period, of course, or two key periods in your IS10 assessment. The main one, of course, is what is your year end, because that will be your cutoff to determine did that event or issue exist at year end. And then the second date is when is the financial statements issued for use, and that's the second one, and then that's the period but after the reporting date, but before the issue period. So in any IS10 question that you identify IS10 as an issue, those two dates are extremely important because that will determine your assessment of, first of all, when the transaction occurred, before year end, after year end, and then if it's after year end, did it happen or occur before the financial statements were issued? And then you will see that was the date of authorization we've discussed. And then with regard to your disclosures, what you would discuss but for that period. But while the financial statements have not been issued, there are some certain disclosures that you will do. And then with regards to the non-adjusting events, events that existed or that only occurred after the year end, but before the financial statements were issued, you would only disclose that in the notes, of course, based on the nature of the event, whether it's material, and then you will give an estimate of the financial effect or statement that such an estimate cannot be made. But luckily, from our perspective in the standard, they actually do provide some guidance on what type of non-adjusting events are there. So if you go to the standard, they would say, for example, a major business combination, which we'll handle after the standard, IFRS 3, that would qualify as a major non-adjusting event. It could be announcing a plan to discontinue operations, the destruction of a major power plant or production plant, or announcing or commencing the implementation of a major restructuring, etc. So in that regard, the standard must be your friend. You don't need to know all of those events off by heart. You would refer to that only when you see it's an IFRS 10 question, whether I need to, whether it's an adjusting event, I will have to go and adjust for it in the financial statements, or if it's a non-adjusting event, it's a disclosure item. So you'll see there is a quick example just to sort of bring together what we have discussed. So the first one is, okay, I'm just going to look at the required first, just to determine our year end, 31 March. So that's our first date. The second date, of course, which is very important, would be the date that the financial statements are approved for issue or authorized. So based on the information that I copied in here, we cannot see that date, so we can just assume 31 March is our year end. All the other transactions falls before that issue or approval date. So you can just see at the top, sorry, let me continue with the please note. It was poor exam technique for me not to read that and just to jump to the scenario. The please note is very important. Assume that all amounts are material and that the company is a going concern. We know, okay, the material portion, we see it emanates from the standard where each material non-adjusting event is also disclosed. So that's important that we don't have to assess that in our discussion as well. Okay, comparative figures are not required. So the first one is just the factory that was destroyed. The second one, you can see on 14 April, which is after year end, we're being sued. And then again on 17 May, after year end, they decided to declare an ordinary dividend to shareholders registered on year end. But I mean, that is irrespective of our decision, how we will adjust for it. That is the declaration happened after year end. That's a non-adjusting event. So if we just go then to disclosure, you can see events after the reporting date, that's IS 10.5. So again, if we look at good exam technique, it would be start with what is being required, disclose the events after reporting date. And then when we go to the disclosure requirements, that actually states or provides the guidance of what to disclose. IS 10.5 provides us with that paragraph to disclose. Then the lawsuit we will disclose because it's based on IAS 1022J, the fire damage. That's part of that guidance that they provide of material non-adjusting events, the contractual equipment or commitment, dividend declaration. So there is our disclosure. It might seem very easy now that I present it in a slide, but remember, if you see that in a question, you should be very happy and comfortable with your exam technique to use your standard as basis and disclose or to first discuss, if it's a discussion question, what is a non-adjusting event or what is an adjusting event based on the scenario, compare the two if you have to. And sometimes it would be that it's a combination between the two. One discussion point might be a non-adjusting event, and you would have to discuss why is it, and then it's after year end, but before the financial statements were issued, it is material, so yes, it should be disclosed, for example. Or no, it was the lawsuit existed at year end, so they should actually go back and adjust for that event in the financial statements to correctly reflect it, then of course based on the required that you address. So that was a nice short and sweet introduction to IAS 10. The questions, of course, that you can get, I think, will predominantly be discussion type, where you have to discuss whether it is an adjusting event, non-adjusting event, how to adjust for it, maybe the correct amount to disclose, etc. But of course, it could also be a counting or disclosure question, whereby you will have to then adjust the financial statements that were given for that adjusting event. So it might be that you still then have to process a journal or disclose a statement, etc. So I think it's important just to be open for the questions, but I think this is a nice, easy standard. But definitely take the time just to revise it and ensure that if you get a question, you are able to get the maximum number of marks. So I'll pause there. Are there any questions at this stage? Okay, great. Now let's get to one of the standards I'm sure everybody was looking forward to attending this evening and learning more about, IFRS 3. It's definitely a standard that you should be very happy if you get it in the exam, because if you understand the principles, there are lots of easy marks available. It's not that difficult to determine what is your shareholding percentage, how to calculate the consideration, the at-acquisition adjustments. And like I mentioned on Monday as well, when you proceed later on to Learning Unit 5 and 6, again, if we ask subsidiaries, if it's a foreign operation, if it's a change in degree of control, if it's a consolidated statement of cash flows, related parties, etc., IFRS 3 will always be applicable, because we will have to tell you what you paid for it, or you will have to calculate it. We will have to tell you what are the net assets at year or at acquisition date, and those you will have to then adjust if it's not at fair value. So this is really a standard that you should look forward to studying, and of course then getting in the exam, because you can then take a lot of confidence into answering the questions. So let's start at the proficiency level. See, it's important, of course, to take a look at it. I know your the annotations or comments that you can make in your standards are limited, but if there was a way, of course, it's easier if you can link these exclusions, especially to specific paragraphs in your standard, that you don't unnecessarily waste your time going through them while you are reviewing IFRS or reviewing IFRS 3. So I'm just quickly going to go through. One of them, of course, is identifying a business combination. It's only level 1. I'll come back to that later, but then you can see identifying the acquirer, so who's the purchaser or the parent, that's excluded, pre-existing relationships, reacquired rights, share-based replacement awards, reverse acquisitions. Looking at the standard, this is sort of a comprehensive standard, but it's very important to always refer to the application guidance in Part B, and they also have illustrative examples as well. You need to revise or see additional examples, and those contain specific details with regards to intangible assets. So this evening we are going to do a short example, I think, with regards to a customer list, for example. But just because we are using the same example as in the learning unit, it's not to say that's the only thing that can be asked. It's still a trademark or a master list or whatever the case may be, any of those. And then it's important that you just know the technique of when is an intangible asset recognized in terms of IFRS 3, meaning it's separately identifiable, or it's in terms of a contract that it's existing. I also just gave a brief summary with regards to the application guidance, so that you can see actually what it covers. So you'll see actually identifying a business combination. Remember, that's level 1. So it's very interesting that the concentration test is also in terms of level 1. And I thought I'd just highlight that. I had a consultation where somebody also asked me with regards to the concentration test. And while it's good to know about it, I think it's good that, yes, it's only level 1 awareness level. So I don't think you should expect a full-on 20-mark question on, in terms of the concentration test, determine whether it's a business combination, etc. So I thought I'd just highlight that as well. But then you can see reverse acquisitions, it's excluded. Then, of course, there are some items that are included that you should study. There you can see intangible assets. The assembled workforce, I think, is also in one of the examples that we're going to do later, but it's just to illustrate the process of how to identify it. And then included in the application guidance as well are some additional items not necessarily covered in the IFRS standard itself, where in the standard itself, it does cover the situation where it's the subsidiary is a lessor in a lease, where, of course, in the application guidance, it's just the other way around. It's when it's a lessee. So the nice thing about IFRS 3 is everything that we do recognize or measure at acquisition is in terms of the standard. So if you're going through a question and you're not sure, but why are we not recognizing it, or why are we recognizing it, and why are we measuring it this amount or not, please ask us, or you can go to the standard as well and find the specific paragraph. I see there's a hand, you can come through.
Thank you, sir. I just wanted to ask a question with regards to what you just said now with regards to reverse acquisition. You just said that it's not included. I just wanted to, because when as I was looking in the slide that you, oh, okay. Oh, because when I looked there, I didn't see where it said it was excluded. Okay, I can see where. Thanks a lot.
Okay, great, John. Thank you. Okay, so this next slide is actually just an overview, but I'm going to skip it. You can see the first part is with regards to whether it is a business combination, and we now know it's awareness, but it is important to make that distinction that for IFRS 3 to be applicable, it must be a business combination. And the business combination, it's not purely buying an asset that might also have a liability, etc. It must be able to, want to use the term actually, earn money, earn revenue. There must be able to be an output that flows from that business before IFRS 3 is applicable. So that's just an important starting point with regards to IFRS 3. This is the first example. It's just to illustrate what is the difference when IFRS 3 is applicable or whether it's not applicable. So here we can just see A entered into a transaction with B, where it purchased assets for an amount of 100,000. But then looking at the underlying assets, we can see the carrying values in B's records is only 67,000. The fair value is 80,000. But now we can see, oh, okay, we paid 100,000. So let's look at option A, where it's not a business, and how we account for that. We would say, what did we pay? 100,000. And then proportionately just allocated to each asset, and that is the asset value then that we carry. So there's no goodwill, no other adjustments. It's not a business combination. We just take what did we buy and divide it equally, or not equally, proportionately to each asset based on its underlying fair value. So then it's easy, no deferred tax as well, because in the separate records for SARS, you would be able to claim the allowance, of course, on what you've paid for it. The only issue here would be if the value that you recognize is higher than the fair value, so 50,000, there might, of course, be some impairment assessments that might come into play. If you look then at part B, or required B, if IFRS 3 is applicable, then what does IFRS 3 say? Assets and liabilities at fair value. So there we would measure at fair value, and then the difference between our consideration, the fairly valued assets and liabilities, gives us our goodwill. So it's nice, short and sweet. It might seem oversimplified, but that is the basis of, or the premise of IFRS 3. So at this point, I want to ask, or I'm going to put up another poll. Do you think now that we see it is a business combination, is a limited required to prepare financial statements? What do you think? Okay, so I'm very glad I put up the poll, and I can see it's leaning towards quite a large to yes. And the actual correct answer would be no. They would not be required to prepare consolidated financial statements. And the reason would be, if we go back to the scenario, they bought the machinery from B for 100,000. They bought machinery inventory debtors. They did not buy the shares in B. They bought the assets from B. So that's a very important distinction, and that will go into your required as well. So why that distinction is important, of course, is if the required says prepare the separate financial statements of A, then you know, okay, this is the transaction that should follow. If they say prepare it from the perspective of B, you would know, okay, they would have to de-recognize the assets, recognize the consideration received. But if it was that A bought the shares in B, then there's a third entity, the consolidated entity, and then we would say, okay, but now we also have to consolidate. So it's just important that distinction to be also very clear when you get to a test or the exam, especially for consolidations or groups, from which perspective are we asking the required? Don't just assume that it's the group financial statements that's asked. It might be that it's the subsidiary statements, even very seldom, but it could be, or the parent, which is more likely as well. So you'll see in the slides, there are some flow charts provided. It's just to provide you with an overview of IFRS 3, but like we discussed, identifying the acquirer, whether it's a business combination as awareness, and then very importantly that it's applicable when the entity obtained control. So IFRS 3 is only applicable when there's control involved. When you IFRS 10, or like in this example where we bought the actual assets, it is ours, so control is not an issue, we have the legal title. So would IFRS 3 be applicable in IS 28, for example? I know I don't have a poll up for that one, for the question, but you can just indicate yes for it would be applicable, or the cross for no, IFRS 3 will not be applicable for IS 28. Okay, great. Thank you for all the responses, and thank you for being interactive as well. And remember, it is anonymous, so I definitely can't afterwards identify. Who answered what? So feel free to participate. It is anonymous. But in any case, coming back to the answer is no. IFRS 3 will only be applicable for IFRS 10 because of control. When we have an investment in associate, that's significant influence, we don't have control, IFRS 3 will not be applicable. So when you get to Learning Unit 5 for IS 28, you will see in IS 28, it says how to calculate goodwill and excess, and it's the difference between the fairly valued net assets and your consideration that was paid. So it has its own set of rules, very limited compared to IFRS 3, but it's just important to know and understand that distinction, that IFRS 3 is only applicable once when you obtain control, therefore only for IFRS 10. This question was just to illustrate the at-acquisition journal. So I don't necessarily need to go into too much detail, but it was just to say that, okay, it's not a fully owned subsidiary. We only have 80%. We bought it for 100,000. The equity at acquisition is 75,000. NCI measured at 7. What will the journal look like? We'll bring in equity, share capital, retained earnings. NCI was given as fair value. There's our investment. We recognize the machinery, inventory, debtors at their fair value, and the deferred tax with goodwill balancing. So at this point, you might ask me, but wait, in that previous example, I actually brought in the machinery at 50,000. Why am I only bringing in 5,000 now? And you will see from the next slide, it was with, I borrowed it from Monday's lecture. You'll remember that we have our starting point for the consolidation is the combined trial balance, which includes the assets of the assets of the subsidiary, gives us our combined trial balance. So before we start with our at acquisition journals, the carrying amounts are already included in our combined trial balance because we have the subsidiary. So the subsidiary is carrying the machinery at 45,000. So to actually get that machinery then to 50,000 is I will have to write a pro forma journal for the 5,000 for machinery. So this is again just to illustrate that principle, which would hopefully assist you quite a lot in doing a consolidation question. Remember the starting point, it's the combined trial balance. We're working towards, it's one economic entity. What should the consolidated balance be? And then the pro forma consolidation journal entries are required. Moving on then to the Mickey and Minnie question, from which the trial balance is also obtained. It will just show you, here is our at acquisition journal. There was our IFRS 3 adjustments included as well. There's our inventory that we just increased to its fair value. The debtors we had to write down to its fair value, recognize the deferred tax on those movements. Of course, because we are adjusting the carrying amounts of the assets, the tax base stays the same, so we're adjusting the temporary difference. That's the reason for the deferred tax. And then also remember from Monday, I said the at acquisition journal will never change. So even if we bought the subsidiary 10 years back, this journal will stay the same. Then now when we go back to our trial balance, we'll say, okay, what is our starting point? Combined trial balance. What did we already post? We posted an at acquisition journal. What should our consolidated trial balance look like? Now, if I look at my answer in Mickey and Minnie, my starting point includes at year end, no inventory at acquisition that's remaining. And the reason I can state that is inventory is a current asset. It's disposed or sold within 12 months. Minnie was bought on 1 January. At year end 31 December, when we do the consolidation, that inventory is not there. But now in my at acquisition journal, I'm recognizing inventory at fair value. I'm debiting inventory that's not there. So my IFRS 3 adjustment that is required subsequent to that is to reverse what was done at acquisition to keep my consolidated trial balance in mind. So from my consolidated viewpoint, there is no inventory anymore. That inventory, sorry for my bad highlight, was disposed, but the at acquisition does not change. It will always stay that same. Therefore, I have to reverse what I did at acquisition with regards to inventory. And then that similar principle is followed for the trade debtors. The deferred tax, of course, follows that as well. And then we can say, wow, shoot, now that I've looked at my at acquisition journal, any adjustments that have flowed from that, I have now processed because share capital, no, nothing will change. Retained earnings at acquisition, nothing will change. My investment, of course, stayed the same. NCI at acquisition cannot change. That's the same. Of course, my goodwill based on IFRS 3 will not change. So at this point, I can say my IFRS 3 adjustments is now complete. And then I can say, okay, it is a subsidiary. Now let me start with my normal consolidation procedures. It is one economic entity. I must eliminate or reverse any intergroup transactions, and then I process those transactions from there. So I hope from your perspective, you look forward to a lot of IFRS 3 adjustments because there are a lot of marks available. But of course, if you understand the principles. The next slide is I just wanted to give you some examples of how would you know there are IFRS 3 adjustments required. The first one all of you would possibly recognize from Nikki and Mimi. We would say all the items are at fairly valued except for the items listed below. The other example was the same. UBA's property, plant and equipment consisted of several buildings. The fair value amounted to 10 million and 12 million on the acquisition date. So the more of those transactions you see, the more happy you should be. Another example would be all the assets and liabilities were fairly valued except for. So if you see that, be very happy because you know, then I can put on my IFRS 3 hat because I am interested in IFRS 3, what happens on my acquisition date. So if we just tell you all the assets and liabilities of School Boutique were fairly valued, and we just pause there, and we could continue that sentence to say, and no other additional assets, liabilities, or contingent liabilities were identified. That means you can take off your IFRS 3 hat, put it in your bag, and be disappointed for the rest of the test. I see there's a hand. You can come through.
Hi, Say, how are you?
Good in yourself.
Okay. My question is with regards to Journal 2, Journal 3, Journal 4, and Journal, yeah, it's just 3, 4, 5, right? So I just wanted to ask, what if instead of, because I got confused, if I received that question in terms of critical evaluate, the way the memo is, I'm gonna like kind of maybe fail it. What if I said I debited my inventory with 16,000 and I credited equity at acquisition with 11,680, right? No, not on journal 1, on journal 2, 3, 4.
Okay.
Yes, for that inventory, I debited inventory with 16,000. I credited equity at acquisition at 11,680. I debited deferred tax of 4,320. And with the next one on the trade and other trade receivables, I debited equity at acquisition. I debited deferred tax. I credited allowance for credit losses because it decreased. So I'm thinking that probably is just an allowance. And my maybe narration for the inventory, I say pro forma remeasurement of inventory at group level. And for the next one, which is for credit loss, I say pro forma provision for credit losses at group level. Will I be marked wrong? Because I'm so confused with crediting cost of sales and inventory. I don't understand what's happening there. The only thing I understand is deferred tax.
Are you happy with the fact that inventory is credited? Let me start there.
Inventory is credited. Those amounts were not fairly valued. So somehow I have to debit my inventory. Basically, I think my journal is to measure the inventory at a remeasure the inventory at a group level. It's more based on the equity at acquisition amount. So that's the reason I can't understand that question, because I tried doing this question again, like in the volume 1, and in the volume 1 they did the way I am trying to explain, just that it's a different example. So I don't understand what is happening there.
Okay, without referring to the example in group statements, we'll have to refer back to that just so that I'm accurate in the answer. I can maybe only refer to the specific journals that you're highlighting and the principle that we are doing. And the first one is in journal 1, we are fairly valuing the assets and liabilities in terms of IFRS 3. So inventory, let me just stick with the inventory one, and the trade debtors one we can discuss later, but it's the same principle that is followed. But we're saying inventories, the fair value is too low, so we must recognize it at 16,000. Now, subsequent to that sale, or the at acquisition adjustment, the subsidiary has sold the inventory in its separate records. So if I look at my at acquisition journal, I cannot just leave it journal 1 and say my IFRS 3 is done, so I don't need to do journal 2 and journal 4. I can just continue to IFRS 10, because if I look at my starting point of the combined trial balance, that trial balance, and I look at my inventory of Mimi, it does not contain that inventory anymore because it was sold, and I can correctly assume that because it's a current asset and these financial statements are presented or 12 months after the acquisition date. So now I have to think of, but in the separate records of Mimi, when it sold this 16,000, what would the entry have been? And it would have said debit bank, credit revenue, debit cost of sales, credit inventory.
Yes.
I must say, how I just explained it might be a bit more confusing, but the issue that I'm trying to illustrate is that the subsidiary would have recognized this whole sale transaction in its separate records already. But from a group's perspective, we already had the inventory at a higher amount of 16,000. So what we are doing in Journal 2 is just to say that inventory is not there anymore. It's not there on our starting point. It's not there in the combined trial balance. It's not there in the subsidiaries records. So if I just leave it at Journal 1, I'm actually overstating my inventory with 16,000 because it's not there. And then the contra entry to actually then reverse the 16,000 would be, what is the line item that we normally use to adjust inventory with? And it would be cost of sales. And then with debtors, like you say, with regards to your loss allowance, that would normally fall under our other expenses, profit and loss. But the other expenses description is not as important. The P&L is important. So if you write bad debt or allowance for credit losses, P&L, that would still earn you the marks because that is the line item that relates to the item that we are reversing. So start with what did we do at IFRS 3 at acquisition? And then subsequent to that, you must ask yourself, but what should these adjustments at acquisition be at consolidated level? And for those two items, I can say I should reverse what I did in that journal because those items are not there. I hope that makes sense. But if you still struggle, would you mind setting up a consultation, and then we can maybe just take it outside the class this evening, if that's fine.
Yes, I think that will do because I'm confused.
Okay, yeah, but it's an important principle, and I think it's coming back to that issue. If you understand the principle, why are we doing it, how are we doing it, when are we doing it, then if you get a similar question and it's say PPE, or that the inventory is now reduced in the test or the exam, then you still know, okay, it's been longer than 12 months, or they tell me in the scenario that the inventory at acquisition was sold within 1 month after the acquisition. Then you know, but this reversal journal is required of what I did in my at acquisition journal. So it's an important principle to understand, because you will lose out on a lot of easy marks if you don't do any of these reversals.
Okay, thank you, Sam. I'll just take it to a consultation.
Okay, thank you. Was there another question? Very fine. Okay. So this was just to illustrate the wording that can be used and to look out and look forward to getting it in the test or the exam. This example will now look a lot more simple than what we've just discussed. This is just a straightforward the fair value difference of land. Sorry, I was just looking for the word. Land that's fairly valued at 175,000. The carrying amount is 125. So we know, okay, what is the adjustment that should be made at acquisition? There we say again, our starting point is the trial balance of the subsidiary for our combined balance. It has a balance of 125. So we should recognize the incremental 50,000, recognize our deferred tax, inside that proportionate share. So there's the 20%, and there's our at acquisition journal. We're very happy, easy marks to score. Why we included the slide with regards to intangible assets? it's just to illustrate the IFRS 3 Appendix B. They actually give a lot of criteria and additional points to consider when discussing intangible assets. So if you do get a discussion question to determine whether or discuss whether a trademark or internally generated customer list, sorry, that's the only thing that's now stuck in my head, but then go to your standard, see what is the principle or the technique that you should use. And of course, similar to IFRS 10, where you discuss control and then power, for IFRS 3, you would discuss all identifiable assets and liabilities should be recognized. I mean, this includes intangible assets. So then you will discuss whether the intangible asset is separable, meaning also whether it's through the contract legal criterion as well. And you'll see they do provide additional guidance to say, but if something, you cannot transfer it, you cannot lease it, you cannot sell it, that's actually also to say, but yes, it's maybe identifiable, but it's not separable because we cannot dispose of it. We cannot get rid of it. So it's just to use that as basis for any type of discussion questions as well. Because remember, IFRS 3, it's not only calculations, calculating goodwill, etc. It might also be to discuss why or how to recognize the intangible asset at acquisition, or how to recognize the contingent liability at acquisition as well. So yeah, here's my customer list that I've been busy on all night. So see, it's frequently licensed. Yeah, it meets the separability criterion. For example, IFRS 3 B37, they talk about a workforce, but the workforce cannot necessarily be separated from the subsidiary. Therefore, it's not identifiable, not an intangible asset. Here's just a short discussion then of that customer list requirements. You'll see the good exam technique to start off with. What does the theory state? What is this principle that we will use? And its top lines must recognize separately from goodwill the identifiable intangible assets. So here we can say then they acquired a unique customer list that are frequently licensed. Therefore, it meets the separability criterion. However, then there's a confidentiality on the customer list that prevents them from being sold. So therefore, this additional information ensures that it does not meet the separability criterion. Therefore, it should not be accounted for as a separate asset in the consolidated financial statements. So it's just that sort of same formula that is applicable to the accounting standards discussion questions. So the nice thing, remember, is always when you look at a solution, it always seems so easy, but it's now transferring that it looks easy to being it is easy in practice. And I think that's an important step to do while you are revising the questions as well. Then with regards to IFRS 3, the main principle, of course, is all the assets liabilities measured at fair value. But there are some exceptions with regards to measurement, meaning they are not measured at fair value. But luckily or unluckily for us, all of them are non-examinable. So I'm just going to skip that. Some of the items are exceptions to the recognition and measurement criteria. For example, the deferred tax, you don't necessarily recognize at fair value, and you don't necessarily recognize them even. So in that regard, you have to apply IAS 12. For employee benefits is IAS 19. And for indemnification assets, it follows the contingent liability treatment. So you'll see for contingent liability, it's an exception to the recognition criteria with regards to recognizing all identifiable assets and liabilities. And then let me just see what the next slide is. Yes, the indemnification asset. So let me first start with the contingent liability, because that is the main driver of the indemnification asset. So of course, a contingent liability, we do not recognize. There's two options of when we do recognize a contingent liability. The one is the present obligation exists, but one or more of the recognition criteria are not met, or that no present obligation exists. But IFRS 3 specifically has a inclusion criteria that if it's not probable that economic outflows of benefits is required, but the amount can be measured reliably, then in terms of IFRS 3, we would recognize it as a liability. And if you think about in practice, it makes sense. If you know there's a pending lawsuit, for example, of R1 million, And you see, but yes, the opinion of the lawyers is that there's no outflow required to settle it, but you can actually say, but wait, taking the probabilities into account, if the judge does not decide in our favor, I might pay 500,000, for example. So it's being prudent and to say, because if we did not recognize the contingent liability as a liability, that impacts our goodwill, of course, and our goodwill would in any case have been higher. So this is just to ensure that we recognize all of that. But then this is where the indemnification asset then comes in. It's to say that the sellers and the purchaser, they see, oh, but there's this pending lawsuit. I might be responsible for paying something that's not even my fault. You did it, but now that I buy it, it's going to become my problem. And then the seller might say, okay, I see your point. It is true. Let me see if the judge do decide against us, I would reimburse you, say, half of the claim. So in our example, if the fair value was 500,000, I would say, okay, if the judge decides to award you that you must pay it, I will reimburse you 250,000. So that is what the indemnification asset, the seller indemnifies the purchaser with regards to a specific outcome. But of course, they can indemnify fully, that it's 100%. So then the indemnification asset would agree 100% to the contingent liability, or it might be it's only 10%, 50%, whatever the scenario states. So it's just important to state to that. And then the last thing that I want to mention with regards to the indemnification asset, the accounting treatment follows the contingent liability. So I'll just repeat that. So if you recognize a contingent liability at 50,000 fair value at acquisition date, if at year end it increases to 100,000, then of course our indemnification asset would also follow that to say, but now it was not only say 50% of 50,000 that I can recognize as an asset, the value of the contingent liability has increased to 100,000. So now my indemnification asset would also increase with 100,000 times 50%. So it would increase to 50%. Sorry, I lied when I said it was the last thing that I wanted to say with regards to indemnification asset. The last thing that I wanted to say is the deferred tax treatment also follows the contingent liability. So if the contingent liability does not have a deferred tax implication, the indemnification asset will also not have a deferred tax implication, and vice versa. So it's actually a fairly easy concept. You should be very happy if you see, oh, there's a indemnification, they're going to reimburse, and you say, yes, there's an easy marks because I just need to put in another line item that follows the accounting treatment for the contingent liability. There's a hand, you can ask your question.
What circumstances will lead to contingent liability having a deferred tax? Because I always thought that contingent liability should never have a deferred tax.
That is a very good question, and it relates then to our IS12 criteria for when we can actually recognize a deferred tax asset or liability. So for the liability, let me just quickly, sorry, just give me a minute. So the tax base of a liability, like the contingent liability, will be its carrying amount less any amount that will be deducted for tax. So if they, in the solution, or sorry, not solution, the scenario, they say that the lawsuit, and then if you have to pay, it will not be deductible for tax, then in that case, your tax base equals your carrying amount, meaning there is no deferred tax, because you won't be able to deduct that lawsuit payment, for example. So in that case, you should let the scenario guide you. You won't be left to determine whether the claim is of a capital nature or an income nature. We normally provide you with that information to state that if the claim is successful, it will be deductible for tax. And if it is deductible, then we'd say our tax base is our carrying amount less the amount that we can deduct. Okay, we can deduct the amount. So our tax base is 0. Yeah, therefore, there is a deferred tax asset that is created. I hope that answers your question.
Yes, thank you.
Okay. Then our next step that we are now addressing, which we've already touched on, was our assets and liabilities. We've recognized it at fair value. Hopefully all of you are very excited to get it in the test. Hopefully you're even more excited if it's a depreciable asset or an intangible asset with a useful life, because then of course you will also have to recognize additional depreciation or amortization as applicable to correctly adjust for the IFRS 3 adjustment at acquisition. And the reason that I can state that is you must again remember the starting point of our consolidation. It's the combined trial balance. So if we are adjusting a depreciable asset in our at acquisition journal, of course, the subsidiary would not have recognized depreciation on that difference between the fair value and the carrying amount. So from a group's perspective, we will now recognize that depreciation. So if you see a useful life item, intangible asset or PPE, be very happy. It's easy marks to obtain as well. Then moving on to the consideration, what is the implications for that from IFRS 3? And the main principle that again that you should remember is fair value. So use fair value. So if you forget in the exam and they give you lots of different amounts, etc., always default back to the fair value. I see there's a question in the chat with regards to what will guide us on whether to consolidate or it is a business combination in a test. I'm not sure I understand the question, but I think earlier in this presentation, you would see that we will only consolidate if we obtain control over a subsidiary. So if it's another entity, subsidiary, then of course IFRS 10 will be applicable and we will consolidate. But IFRS 3 can also be applicable if you buy the actual assets and liabilities as well. Then you can, and if it is a business combination, IFRS 3 is applicable, but then of course no consolidation because IFRS 10 is only applicable if there's a parent subsidiary relationship. But if we buy the assets, we own it, it's in the separate financial statements of the purchaser. So if that doesn't answer your question, you can just ask a follow-up question. Okay, then coming back to the presentation, you'll see consideration measured at fair value, except where assets and liabilities transferred remain within the group. And let me just explain that by stating, remember, if the parent transfers a PPE item, which it controls, to the subsidiary, it also controls the same item both before and after the transaction. Therefore, that item is transferred at carrying amount. So it's fairly easy. There's a specific paragraph in IFRS 3 that also explains that concept, but it's just to say that for a subsidiary, if we transfer an asset to the subsidiary as part of consideration, we own that both before and after the transaction. You can ask your questions.
Hi, Sam. Could you please explain how can we identify that the assets and liabilities remained within the group?
That's a good question, and I'll use this slide that we are currently on. You see, it says, I just included the slide just as a illustration that you should look forward to getting this type of detail in the test or the exam, because it's easy marks, because the main principle for consideration is fair value. So there we have a cash amount. Yes, that's a mark. There's cost directly attributed. Yes, that's another mark. There we can see, this is your question. I'll get to that now. The issued ordinary shares, great. I now must use the fair value of the shares when I calculate the consideration. So a question like this, it's nice. You will get a lot of marks, maybe 4 or 5 even, for being able to calculate the consideration. So I hope everybody's looking forward to that. And then coming to your question specifically, you'll see it says the transfer of furniture to school boutique to be used for business purposes. So you'll see they say that that furniture is not transferred to the selling shareholders, it's transferred to the subsidiary. So, and that is our flag or our indication that wait, I must remember that this furniture, it's transferred to the subsidiary. I control it both before and after. And you'll see even this question, it made it also easier in the sense that the carrying amount and the fair value is the same amount. But if it did differ, we would use the carrying amount for the purpose of determining our consideration, and no adjustment is further necessary because now the asset is with the subsidiary, but at the correct value, at the carrying amount, because the group is one economic entity, we transferred it at its carrying amount because we own it both before and after. It's actually a much easier accounting treatment as well. I hope that answers your question.
A quick one, sir. So if we transfer, if you say we consider the carrying amount, then it means that from our side, we won't have excess equity that we will recognize at acquisition.
For that specific item, no. So that item is only considered or taken into account when calculating now our consideration. So when we say we've paid cash of 5.8 million, we'll also add 680,800 as furniture. And then that's our consideration already at, say, 6.4 million. So that's the purpose of that. But remember, when you do the consolidation, it would be important just to reduce the parent's fixtures or furniture with this amount, and to add that amount then, of course, to the subsidiary's furniture, because that is what happened. So your starting point would be the trial balance combined, and then that furniture would already be with the subsidiary at the correct amount. I see there's two hands. Number one, you can come through.
Good evening, sir.
Yes.
So sir, sorry to bring you back to this. Let us assume we have as an IFRS 3 adjustment, we have a depreciable asset in the form of PPE. So to bring it to the fair value, we will have that extra difference between the carrying value and the fair value, and then we will depreciate it using the remaining useful life. But what happens if we sell it before depreciating it over that? We sell it in between.
That's a very good question. And the answer would be we sell it at the price, of course, that we will have to tell you what is the fair value of the consideration that you received. But then at that date, any of the unrealized profits, etc., that was still outstanding, it now realizes because that asset is now transferred to a third party, an entity outside of the, what can I say, outside of the group. So you won't need to depreciate any further. You would just state up until the day that it's sold. From a group's perspective, the carrying amount is correct. There is no unrealized profit or losses that's still lying with that asset, because from a group's perspective, we just recognize it at fair value at acquisition. The subsidiary continued to depreciate the asset. At the group level, we've recognized the incremental depreciation. So at the date that we sell, there's a carrying amount in the subsidiary's records, but there's also a calculated carrying amount in the group. So yes, the profit would be slightly different, but we would then just set it off to net it to realize it that we reverse the accumulated depreciation, de-recognize the asset at cost, and then that is our de-recognition of the asset. I hope it makes sense. It would be easier, I assume, to have an example on that, but yes, in practice, you would just say that there's a difference between the carrying amount in the group versus the subsidiary, but you must just ensure, again, your starting point is the combined trial balance. When you look at the consolidated trial balance, what you should look at is there should not be any asset left. So yes, you've recognized an IFRS 3 at acquisition journal, adjusting the fair value. You've subsequently recognized depreciation. So at the date of sale, you will just have to reverse any remaining fair value adjustment that's left in the group, just to ensure that that asset is no longer there, which is how it should be from the consolidated group perspective.
Okay, so which gives me a follow-up question on that also. Let us assume we have sold this asset at 2026. Now we are doing consolidated financial statements for 2027. So won't there be an IFRS 3 adjustment, because the at consolidation will always remain the same?
Yes, that is 100% true. The adjustment would just be that in the prior year then, because it's now 2026, we would just reverse what we did at acquisition against retained earnings. So we would say, for example, that at acquisition, we said debit machinery 10,000. Now, subsequently, it was sold already. So the net effect of all the cumulative depreciations, etc., that we did recognize, of course, we did not need to recognize it anymore because the asset is not there. So we would just reverse that 10,000 fair value adjustment asset in the prior year against retained earnings.
Okay, thank you so much, sir.
Okay, the next question can come through.
No, it's okay, sir. I got answered.
Okay, great. It's 2 for 1. I like it. Nice. Okay, so this page was just to illustrate the different types of consideration that we can pay. And then another question that we also get quite a lot is the acquisition related costs one. So I thought, let me just bring in a slide with regards to that. And IFRS 3 specifically say all the costs are expensed. So finder's fees, advisory, legal, accounting, valuation, etc., except if it relates to issue costs with regards to debt or equities. So let's first pause at the other fees and how it should be expensed and look at a practical example at the bottom. So in the scenario, they said we're paying a cash consideration of 620,000 into the lawyer's trust account. Included in the cash consideration is acquisition-related cost in respect of valuations and lawyers' fees. So they actually tell us that included in that 620,000 are lawyers' fees. So from a practical point of view, if the parent, then in its separate records would say, yes, but I paid 620,000, but IFRS 3 then states I must debit my expenses with 120,000. The other 500,000 remaining, I can capitalize against the investment. And then this is just an overview from the actual question where that principle is illustrated, the 620 to the 120. So from your perspective, it's very important just to follow with regards to what the question says, because the question might have phrased this differently and said, not included in cash considerations. It could just have said, in addition, the acquirer, the parent, paid acquisition-related cost of 120,000. So in that case, it's not necessary to reduce the 620 with the 120, which must be expensed, because they told us now it was paid separate to that. So that is just a principle. But again, there's no standard rule. You will have to look at the wording in the scenario for how to treat the costs. The other thing, just that with regards to the debt or equities, would be rather than saying I've paid 620, they could have said 120 related to the share issue costs, because luckily in this example, there were shares. So say they said no, 120,000 related to share issue costs. Then I would have said credit bank 620, debit investment 500, and then my other debit leg would have been share capital SCE. So that's the principle to follow. But again, you'll just look at the wording with regards to, is any of the cash amounts included in the one amount given, or is it stated as separate? And then for the allocation. So it's not a difficult principle, but it's just important to understand it so that you can save time in the test or the exam if it does come up. I see there's a hand, you can come through.
And so I just want to touch back on the consideration that you spoke about, where you said if you transfer an asset to the subsidiary, you're gonna include it at the carrying amount, right? That's because once the asset will be part of the subsidiary actually before and after. So my question is there anything, is there any journal that you do to add it into the PPE or into the balance sheet after acquisition?
It's a very good practical question. And the reason I will say that is we normally don't tend to think of, but what is the accounting treatment from the subsidiary side? Meaning we would say, oh, but it's only a transaction between its shareholders. It does not impact it at all. But now if you think about it, the subsidiary is actually getting an asset for free. Meaning they did not buy it. They did not exchange it for their own shares because they did not issue shares for the asset. it's a transaction between the shareholders. It was just that as a bonus, they actually now got a PPE item out of the transaction. So now the accounting treatment in the subsidiaries records would be to debit the asset at the carrying amount and credit equity. I don't want to say necessarily a separate reserve, but it would also be called something like owner's equity or something to that effect, to bring in that asset as an amount, but it's not through profit or loss or another asset or liability. It is with regards to an equity item. So normally we just call it owner's equity ACE as the credit entry.
All right. Thank you so much.
Okay. Okay. There's another question. You can come through.
Hi, good evening. I would just like to know, would it be, or would we need to know how to consolidate hedges?
Are you referring to hedge accounting?
Yeah.
As far as I know, hedge accounting is excluded from IFRS 9, so then it would definitely also not be included in your consolidated financial statements as well.
Okay.
But I can just mention, of course, for consolidation, if a specific underlying item is treated correctly, say, for example, in terms of IFRS 9, in the separate financial statements of the parent or the subsidiary, then on the combined trial balance, it would be already correctly accounted for. And then when we look at our consolidated financial statements, it would also be correctly accounted for. So there would be no accounting adjustments required. The only instance where pro forma accounting adjustments would be required in the consolidated records is if we look at the combined trial balance versus our consolidated trial balance to see, but wait, the accounting should be different, or the amount that it's currently reflecting on the combined trial balance, it's not correct. Meaning it could, so there's various instances why it could be different, but no, if it was, for example, a hedge, it's seldom that there would be an intergroup effect to say, but from a group's perspective, that hedge should be at a different amount. Thanks.
Okay, thanks.
Sorry?
Thank you.
Okay. So another hand?
Yes, I just wanted to ask if you could maybe just touch again on how we would recognize if like the cost to issue debt or equity securities was mentioned instead of the other expense that do not get capitalized.
Okay, so for example, if we take the same set of information, if they said included in the cash consideration paid is costs relating to the issue of shares, for example, the shares at the bottom, then we would have just replaced this debit expenses P&L with debit share capital ACE. So the principle remains exactly the same. Any acquisition-related costs are not capitalized against the investment. They're either taken to P&L, written off the costs, or if it relates to the issue cost with equity or debt, the contra entry would be that equity item or that debt items.
Thank you, sir.
The purpose of the next slide, so I see I'm a bit behind. Hopefully the speed is not too bad at the moment. Everybody's following still. So I think it's more important for the quality of a quantity. But the purpose of this slide is just to illustrate again, looking at the required. It's Paint Pro Limited, not Paint Pro Limited Group or the consolidated financial statements of Paint Pro. It was the parent. And you can see the amount of journals required in the parent's records with regards to IFRS 3. So again, it's just that important distinction when you look at the required to understand what it is required. And then if I go to the previous page, it makes sense that there are many adjustments flowing from IFRS 3 when you look at what the parent is recognizing in its separate records. So in the separate records, it said credit bank, it said credit ordinary share capital, it said credit liability of 186,000, it said credit contingent consideration 60,000, it said debit P&L 120,000 to get to debit and investment. But the deferred consideration, the fair value can change, the contingent consideration, the fair value can change. So I think it's just important to remember that once you've done the IFRS 3 at acquisition accounting in the parent separate records, that's not the end of the accounting in the parent separate records. There are or might still be items that require adjustment in the parent separate records subsequent. So don't forget to change the or adjust the fair value adjustment of these items. For example, deferred consideration, normally it's a present value calc, so there's time value of money. So just ensure that you use the time value of money, the interest component, to gross up that value up until the final value when that payment is due. So it's just a pointer to remember the required. It's very important. I'm just quickly going to skip ahead some of the slides because this is a concept that you would know. It's a cash payment, that of 100,000 that's made in 2 years' time, 10%, but it's a similar principle that you saw in test 1 when you calculated the bonds, I think, the present value of the bonds and the interest, etc. So be very happy if there are future payments over or longer than a year, and you can present value, because in most instances that's 2 easy marks just there. And I mean, from a test out of 40 marks, that's 5% easy peasy, and it takes you less than a minute to do as well. So, but it's just that concept. So if you still struggle with it, ensure that you are able to do it. Like you saw, it was in test 1, it could be in test 2, it could be in the exam, etc. So just ensure that you are happy with that principle so that you are able to get those marks. And then coming back to our summary sheet, the next component is just NCI. What does IFRS 3 state how that should be measured? Hopefully you will know by now that there are 2 measurements. One is at fair value, the other at proportionate share. So what is the difference? With regards to proportionate share, is we calculate what are the net assets and liabilities, the net asset value, and give NCI their share of 25%, and that is their value. They don't share in goodwill at all. If NCI is at fair value, yes, then they can share in goodwill. What is important to notice that this goodwill allocation between the two, it's not necessarily at the same shareholding percentage of the parent and NCI. And what I mean with regards to that is we can see that this 7,000 times 25%, it's not 2,000. And 7,000 times 5, sometimes 75%, it's not 5,000. But it does not have to be. So it's just to illustrate that principle. It could even be that the parent has goodwill, NCI has a gain on bargain purchase, but that's 100% fine. We're just interested in what is the amount of the two together to know that in our journal, is it goodwill or excess that we should recognize? So it's just important. It doesn't matter. It can be both excess, one goodwill, one excess. It doesn't matter. And you will see this principle of NCI sharing in goodwill becomes a lot more important when you get to foreign operations learning unit 5. So for our purposes now, this is a good start and foundation to build on going forward. This I just included as, I want to say for completeness, like at the top. So I don't want to borrow the wording for completeness. I don't know why we say that when it's such an important calculation, but it's just to illustrate here the amount of IFRS 3 adjustments that could flow from a specific scenario. You can see there profit for the month, mark-to-market reserve, inventory, intangible assets, contingent liability, and then flowing from that, the IFRS 3 adjustments as well. So, like I say, it's not that too difficult to understand the principles. Make sure that you understand the underlying principle of when should I recognize an asset? Yes. At fair value, yes. It's depreciable. Okay, yes. So I must remember subsequent to recognize, in this case, amortization on that difference. So please just ensure you review it. Like I say, not only for test 2, for test 4, the exam going forward, it's an important concept. IFRS 3, it's in any consolidation question because we have to tell you what date you purchased it, what you paid for it, what was the net assets, etc. And then, like I say, after we've allocated NCI, that's our goodwill gain on bargain purchase. I think we're coming to almost the last slide for IFRS 3. Well, not the last, but there's a couple more. But one of the last principles is just the measurement period. What that is when you acquire a subsidiary, there's actually a period within which you can measure the assets and liabilities at fair value. That period ends the soonest of 12 months or when you obtain the outstanding information. From a practical point of view, how would you know it is applicable? We would have to tell you. We would have to tell you that the acquisition date is 6 May, but on that date, a valuation report was still outstanding. Or the provisional assessment indicated that the fair value was X amount, and then later on 6 June, it was confirmed that it's now amount Y. So we would definitely have to provide you with information that you can see, but wait a minute, the accounting for IFRS 3, the acquisition, it's not complete on that day because there's still information outstanding. And what is the implication for us that there's a measurement period? If I just go back to the analysis, you'll see the implication is as soon as we get that final amount, we would recognize the correct final amount and recognize the correct goodwill amount. So from my perspective, depending on the required, I would not even split the two to say, but the initial goodwill was that amount, now it changes. I would just use the correct amount at acquisition, but again, it depends on what is required. So if they ask you a discussion question, of course, then you don't even need to do an analysis. You can just discuss what is the implications as well. I see there's a question with regards to the analysis. I did touch on it on Monday as well. From my perspective, I like it. It's one calculation. You'll see, especially when you get to foreign operations, you get two additional columns in here. One is the foreign currency, one is the exchange rate to get to the total, then allocate. And it's quite a nice method to calculate the FCTR. But the comments, of course, it's valid to say it does take a long time to complete. And I think that is where your exam technique must be very good. So if you're able to look at an analysis like this, that's 100% complete, you should be able to ask yourself what journal is required for each amount. For example, if I look at this share capital, would I ever need to journalize it? And I would say, yes, if I'm asked for the at acquisition elimination journal, then I have to present that. Or if I look at this amount for NCI, I would say, yes, I would have to disclose it if I'm asked for the statement of change in equity, if I have to journalize a question, or if it's maybe the statement of financial position, including the equity section. But say, for example, they ask for the statement of profit or loss, excluding the amount attributable to the parent and NCI. Then, of course, this whole NCI column would not be required. So don't waste time then spending on it. And then I think if you get to a point where you can say, but okay, this amount, I would not, or I would recognize it there, or in the statement of financial position, or the current year's profit, do I write a journal for it? You would say, no, I don't write a journal for it because the profit of the subsidiary is already included this at 100% in the statement of profit and loss. I'm adjusting 100% of these items in the statement of profit and loss. It's only at the bottom of the statement of profit and loss where I need to attribute or apportion this profit between the parent, between NCI. So if that's not asked, then don't calculate the amount. So there's no one answer or one size fits all. It depends on the required. So I think if you can look at an analysis from that perspective and ask yourself, where should I use each amount, then it helps. And the other option or exam technique, of course, is say you've done this calculation. It's then to ensure, but what amounts can I already use in my answer? Transfer your goodwill, transfer your NCI, for example. If it's SFP, transfer the amounts that you need to transfer. That you know that if you're done with this portion, you know, I don't need to go back. It's used in my answer. I can then just continue. The deferred tax, I've already briefly touched on with regards to the tax base. The tax base normally doesn't change because if you look at from a group's perspective, the tax base is normally based on a company level. So the subsidiary will be the one claiming the allowances, etc. But when we get to a consolidation, if we say, but no, the amount is different, SARS would not say, no, okay, yes, it is different. Let me give you a bigger allowance. No, the allowance is on the company level. It doesn't impact the group. And that's the reason why a lot of the adjustments provides or that a deferred tax liability or asset should be recognized. But it's the same principle that is followed with regards to how do you calculate the tax base for the liability? It's the carrying amount less any amount that will be deductible for the tax purposes. So it's that same principle that is followed. The only last thing that I want to touch on is which tax rate to use. We will use 27% if the carrying amount is recoverable through use, meaning it has a useful life. So if it's an intangible asset that has a useful life, is it a PPE item with a useful life? We are using it, we are depreciating it, amortizing it, it's 27%. If it doesn't have a useful life, for example, land, meaning the only way that we can recover the amount ever would be through sale, and similar for an intangible asset with an indefinite useful life. So we're saying, but the useful life, there is no end, we can use it indefinitely, then we use the CGT rate. But again, if you are unsure in the exam, good exam technique would be go with your gut instinct and then stick with it. You also notice that we don't mark negatively. So I should also not state that it's good exam technique. Good exam technique will be for you to already know what the correct answer is. But if you're unsure whether there should be deferred tax, rather present deferred tax, takes 30 seconds and move on, and you won't lose the marks. They're not presenting it and you should have, and then you lose marks. Okay, so we've reached the end of IFRS 3. The purpose of this slide is actually to say, I have answers. Are there any questions? Or can I proceed to the next section? Okay, and now I'll just proceed then to IS 37. It's also a nice, hopefully short one, but not less important. Again, you'll hopefully also have done this standard quite in detail in your undergraduate studies. So you already have a very solid base as well. But you should also still revise it. IS 37, you can see it even linked with IFRS 3 as well, where we have to apply the principles of IFRS 3 to IS 37 to say, but wait, we can actually recognize a contingent liability as a liability. So you can see it actually, there is integration even between the different accounting standards as well. So okay, the scope is 1, restructuring level 2. The rest is at level 3. It is quite a long standard paragraphs wise, but like I say, hopefully you can also rely on your previous knowledge as well, but you must definitely have a good understanding of the standard. And I've just included some of the more important definitions. And why is it important just to highlight this is, of course, apart from just recognizing a provision, you should also, if it's a discussion question, be able to identify whether it is a contingent liability and why, or whether it's a provision and why, or liability and why. So please go through the standard. You see in the slides, we try to include a flow chart to just help with not only determining whether you should disclose a contingent liability, a liability or provision. This could also help you when you answer a discussion type question to ensure that you actually discuss the underlying concepts that you need to discuss. So you'll see if we just start with a liability, for example, we go back to the definition. A liability is a present obligation arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. So you can see present obligation due to past event. So you would discuss, is it a present obligation? What is the past events? Will the settlement result in an outflow? Yes, recognize a liability. Then we'll come over to the provision or contingent liability. If it's a possible obligation, of course, it can only sort of result in, well, there's actually a couple of options. But the structure of the flowchart is exactly the same, where you would discuss present obligation, possible obligation, outflow of economic benefits, what's the past event, and then what's more relevant in this portion of the flowchart is whether it can be whether a reliable estimate can be made of the amount. We just thought it's important just to highlight with regards to the contingent asset. Of course, you won't recognize it, but only disclose it, because if it does not, since it could result in the recognition of income, but when the realization of income is virtually certain, then of course it's not a contingent asset and its recognition will be appropriate. With regards to how do you actually measure a provision, the standard also provides a couple of helpful pointers, of course, that you will use in a discussion or to calculate in a calculation question. You should always use the best estimate of the expenditure. That is the amount that an entity would rationally pay to settle or transfer that obligation. It is open to a couple of requirements. I think there's 4. I think I only listed the one with regards to the judgment of management, but they do also state experience that goes or that management has obtained, as well as independent experts. And it also includes evidence provided by events after reporting date. So I highlighted this again just to show the integration between the standards, meaning, of course, this is even an IS-10 concept. So even evidence that's provided after the reporting date could still influence what is your best estimate for a provision at the financial year end date. And then the last thing that I just want to highlight here as well is where the provision is being measured and it involves a large portion of certain outcomes. Then we use weighting. And what do I mean with regards to that? So they would assess to say that if we look at the calculation, they say there's a 75% chance that we would pay R0. There's a 20% chance that we would be liable for 1 million and a 5% chance for 4 million. So then we weight each chance probability to then get to then the provision that I would recognize is 400,000. So you see this actually links in quite nicely with it's the best estimate, judgment is used. It might be that this estimate was only obtained after the reporting date, but still referring to the year-end date. So that is then how you would measure the provision as well, using the weighting. Other items just to highlight as well, and then with regard to the paragraphs, it's reimbursements, when changes in provisions can occur, future operating losses, onerous contracts, and restructuring. So I'm not going to go into too much detail with regard to that. That is IS 37. Any questions on the standard? Then the last standard that I'm going to be able to get to is IFRS 15. Let me just pause here then as well, just to state the fact that I'm not going to get to IFRS 13 or started with IFRS 3, of course, you should treat all the standards equally. You will see, or I don't know if you saw, but even in the AIC of January, they actually asked a public sector accounting question. So when nobody was expecting that, they asked an integrated accounting question as well, where you had to discuss different standards as well. What I mean with regards to that is your focus now, short term, of course, is per module, integration within the module, and you should focus on that. What any board course would do, of course, is it would equip you and just open your mind a bit wider to say, but remember, I might ask you now, because you know it's test 2, the topics are limited, it's only the 6. So if I want to ask you an IFRS 10 question, you would know, but if I discuss how the investment can be classified or measured, etc., you would know, okay, it's IFRS 10 that I need to discuss it in terms of. But when you look at or get to AIC, then of course there won't be that limitation. So if they say, but discuss how this transaction should be treated, I mean, then it's very wide. Then you should use your knowledge to identify, but it could be tax treatment even. It could be not only one accounting standard, but various standards. So that's just the reason I want to highlight this at this point is it's even if you don't get something in test 2, for example, it doesn't make it less important for your studies overall. And like I also mentioned on Monday, remember your ultimate goal is still to be an awesome chartered accountant. And I think if you approach your studies in that instance, you'll not only will you study a lot easier, you'll remember a lot better, and even the topics that you feel it's irrelevant or not important, that might also be, okay, let me just double check that I do know what's going on. Okay, so the last standard for the day is then IFRS 15. Again, the starting point, very important, what is excluded, included, etc. And hopefully all of you are familiar with regards to the 5-step revenue recognition model, because then it links in quite nicely that we can see Step 3, changes in transaction price, it's only level 2. But step 1 with regards to the contract modifications, etc., it's also level 1. So even if you do get a discuss in terms of step 1 question, it would be very limited in scope and marks because it's only an awareness level. And then looking at some of the other topics, that's at level 2, principal versus agent, customer unexercised rights, repurchase agreements, etc. So level 2 does not mean you won't get it. It's just that it's a bit more limited in scope, of course. Looking at the standard itself, so we can see level 1, it's paragraph 1 to, the 21, more or less. Level 2, it's only 87 to 90. And then in the application guidance and excluded, it's B52 to 63 and any construction industry questions as well. It's at this point also important just to note that the standard has a lot of illustrative examples. Do you need to know everyone off by heart? No, definitely not. But do you need to be familiar with it? Yes, especially the index to see what type of examples there are. And you will see some of the examples you would also be able to see, wow, but you will see one of the questions we're going to do, it's a warranty question. Say, oh, but here's also a similar one to warranty. And of course, for you, for exam technique, how does that help? Even under exam pressure or stress, you then don't need to sit there and think and structure your answer. You can actually refer to that example and see, okay, what are the main concepts or standard or the paragraphs that I need to go to in the standard. But on that point, just be aware that it will be very seldom that the scenario will match an example exactly or closely. And it might also be that the required is actually goes beyond what the example covers as well. So the illustrative examples is not a 100% answer for each situation. So this is just a quick overview just to say that one standard replaces 6 other IFRICs, IS, and SIC notes as well. For revenue, it's discussion, journal entries, and presentation as well. So we've included it in the slide for revision purposes, just building up to the 5-step revenue model, but I'm not going to go into too much detail with regards to the contracts. I think it's fairly self-explanatory, and it is at the awareness level only. This is the slide I want to get to. Here's your 5-step revenue model. So it's important to be familiar with the terminology. So if the question says determine or discuss in terms of the 5-step revenue model, step 2 to 5, or if they say discuss step 2 only, or step 3 and 4, or they might say step 1 and 2, you can assume is correctly identified, and then they provide you with the performance obligations. So in that regard, the scenario is very important to understand if there are any limitations to your discussion, first of all, and whether some of these steps, of course, is already assumed correct. So then you don't need to go and discuss that. But for example, if they do provide you with step 2 is correct, ensure that you are then able to identify which performance obligations are given in the scenario. Is it only 1, is it 2, etc. That if you have to determine the transaction price or to allocate the transaction price to the performance obligation, you are able to do that to earn this sufficient number of marks as well. Okay, sorry, this is still the contract. Let's start with step 2, identifying the performance obligations. So this is a very important step, of course, self-explanatory. It's the first step that's also level 3, but it's important there is a formula that you can use. So it's important, I try to follow that same formula in the question. You'll see that follows this theory, that how you can answer it and to say, but of course, is it, what is a performance obligation? First of all, it should be distinct, etc., and then what the requirements are to assist you in that process. So the performance obligation could be either a good or service or bundle that is distinct, that's very important, or a series of distinct goods or services that are substantially the same. So that series of distinct, it just refers to, for example, garden services that's provided over a 12-month period. So it's a series, but it's actually the same service that's delivered, but over a period of time. So it's just to say that that could also be grouped. You don't need to, for each month, determine again what is a performance obligation and start from scratch. You can do that at contract date already. So a contract with a customer generally explicitly states the goods or services. For example, A sells a machine to B. These promises may not be limited to those goods and services explicitly stated, meaning other promises could be implied, and implied could be that they create a valid expectation for a transfer of a promise, meaning a free maintenance service. So it's not necessarily to say that we would say you sell product A to B. It might then be, if you read further, to say, but yes, you can bring it in within 7 days for a free exchange. I mean, that's not necessarily explicitly stated in the contract or at contract exception, but as you read the terms, you can say, oh, wait, but there's actually another service that's delivered that could also possibly be a separate performance obligation. So here we start with the application of IFRS 15. A good or service promise is distinct if both are met. The customer, okay, let me just first stop there. IFRS 1527 contains two subsections, A and B. A then follows to provide additional guidance in paragraph 28, and B, additional guidance in 29. So if you have a discussion question for paragraph 27, you would say A is the customer can benefit on its own, and then you will go and look at 28 or any of those requirements applicable. And then for B, you would say, is it separately identifiable from other promises? Yes, you want to discuss that. And you also go to paragraph 29 to see are any of those requirements applicable to the situation. And then factors indicating that two or more promises are not separately identifiable is then followed by, in paragraph 29, you will see if this paragraph B to say whether it is separately identifiable or not. Very nicely, they actually give us a nice checklist. They say, part A, the entity provides a significant service of integrating. For B, it significantly modifies or customizes another good or service in the contract. Or C, the goods or services are highly interdependent or highly interrelated. Meaning, so the example they give here is a computer and operating service, but it could also be even two practical items that the one is customized to such an extent that it only works on product A. So that costs product B, yes, even though you might be able to buy a similar one in the market, if you, in terms of the contract, need to customize it to such a high degree that it can only be used with product A, then you could also say, but it's actually highly interdependent, the one cannot work without the other type of thing. Again, how would you know in a question whether to discuss each of these or how to discuss? It's based on the information in the scenario. So using that same technique from Monday, if you do struggle with revenue to identify when should I discuss paragraph 27A and B and then followed by 28 and 29, for example, look at one of the solutions for a IFRS 15 revenue question and then ask yourself, okay, but now that I have the solution, look at the first paragraph and ask yourself, but what information would I expect to see in the solution, in the scenario? And then go to the scenario and say, oh yes, it is what I expected. And then how that link would help is the next time that you get to a question and you only have the scenario, you already think about, oh, I know what the impact in the solution would be because you have seen a similar principle before. Following, sorry, coming back, after 29, following on then is paragraph 30. Is a question, then if the goods or services are not distinct, then if a promised good or service is not distinct, the entity shall continue to combine goods or services until it identifies a bundle that is distinct. And if it's not able to identify or sort of to go higher up and identify additional goods or services, then that bundle of goods or services gives you your single performance obligation. So that this would normally be applicable if you, at the end of paragraph 29, you end up with to say, but yes, some of these requirements are met, therefore it's not distinct, it's one performance obligation. Then you would also discuss paragraph 30 to say, but because there are no other goods or services that we can assess, it is then a single performance obligation. Okay, then coming to our question, where this is then illustrated in a practical manner. On 1 November, Team Design TD entered into a contract with Greenbag Investments, Green, to refurbish an old business building in Sandton, or old office building. The refurbishment on all the floors of the building includes the following: overall management, installation of elevators, providing electrical services, and providing carpentry services. TD regularly provides each of the above separately. The total consideration amounts to 15 million. In terms of the contract, the consideration must be paid based on the progress of the refurbishment. The date of completion is 31 March. Coming to the required, identify, so it will be A, and discuss, B, the performance obligations present in the contract entered into between TD and Green. You are not required to discuss the satisfaction of the performance obligation. So we only need to discuss which performance obligations we can identify in terms of then step 2 of the revenue recognition model. So then we would start with, in terms of the contract, TD agreed to provide refurbishment services, and then we apply with our theory. At contract inception, TD must assess the goods or services promised and identify as a performance obligation each promised to transfer, whether then it's distinct. And then it would move on to 27. When is it distinct? It's a good or service is distinct if both of the following are met. It can benefit from it on its own or together with other resources, and the promise to transfer is separately identifiable from the other promises for the services in the contract. Then we proceed, of course, to 27A to discuss that. Green can benefit from each of the 4 individually or together, which makes sense because we can identify each of the services. They can put in the lifts separately, etc. This is evidenced by the fact that TD also regularly provides each of these services separately, and then Green could therefore generate economic benefits from each service. So accordingly, we would say yes. The first one, we can see yes, it is separately identifiable for each good or service. But then when we get to B, we can see they must also be separately identifiable from the other promises in the contract. And then, of course, 27B takes us to what does 29A says or say. And then there are 3 requirements. So then we discuss the integration, but they do provide a significant integration because they are combining the project management, elevator installation, electrical services into a single output, which is what the contract called the fully refurbished office building. So there we can say, but yes, there is a significant integration. They have to perform all of the 4 together to actually provide the fully refurbished office building. That is what Green has contracted TD to do. And none of the 4 would be able to provide that output on its own. And then if we proceed to B, which is not required, let me just go to B so that we can see what B was, which was one or more goods or services significantly modifies or customizes another good. So I think in this case we could see, but no, the installation of the lifts does not necessarily customize or modifies the project management service or the painting job, etc. So then, sorry, it's this slide. Then going on to C, you can see each of the 4 services is highly interdependent and interrelated. The overall management directly governs and coordinates the timing. Similarly, the sequencing and scope of the electrical, carpentry, and the elevator installation. So we can see together they are actually highly interdependent, interrelated. The one is dependent on the other. So then in that sense, we can assess that the services are not separately identifiable. And then, of course, when we said it's not separately identifiable, we have to proceed to paragraph 30 to say, but is there another group or bundle of goods or services? And then we can say no. So these 4 bundled together form a distinct bundle, and therefore it is a single performance obligation, being the fully refurbished office. So I know it's a bit one-dimensional. I don't know what other word to use, me just reading it from the slide, etc. That was definitely not the purpose. I know it's a bit difficult with regards to the interaction in this case with regards to IFRS 3, but you have the slides now there with you. The purpose was just to try to illustrate the approach to follow with regards to step 2, how to answer it, to see that IFRS 15 actually provides a sort of checklist that you can use to answer each step. The challenge would come in, of course, that there are various other items or issues that IFRS 15 also raises with regards to, for example, warranties, which will be our next example. So it's important just to have a good overview of the standard, familiarize yourself that if you identify, for example, the next one, warranties, that you know there is a section in the standard, let me go to that. It's just so that you know you have the standards with you, that if you recognize a transaction, you know, I just go to the standard, and then you also know, but like similar to step 2, there might also be a similar format or flow that you can use to structure your answer, whereby you state to say, but when is it distinct? It's if these criteria are met. If one of these two are not met, then it's not distinct. If I just go to paragraph 30, whatever the case may be. So it's almost for yourself to develop a game plan. But if you did get a revenue discussion question, you are looking forward to it and you know exactly how you're going to approach it. You know that if it's step 2, I must discuss distinct. I must discuss 27A and B. If it's 27A, I go to paragraph 28. And now for the next one, if it's warranties, I know that I go to the application guidance. We'll move to that one. I'll go back, but there, I'll go to the paragraph B28, B33 in the application guidance, because I know then what I need to do. And in that paragraph, I think one of those, they also have a checklist to say, but if it follows A or B or C, then yes, it is a separate performance obligation, for example. And it might take a bit of time initially, but you'll see you'll get a lot of confidence in from doing questions by having a game plan on how to answer revenue type of discussion questions. I think that the majority of times when students are not doing that well is because they did not know that the standard actually provides sort of not the checklist, but guidance on what it should comply with or adhere to be able to be recognized as revenue. So let us move to warranties unless there are any questions at this stage. Okay, for warranties, I'm just going to jump into a question as well. So that is in your learning unit, but I just want to highlight some issues as well. A smartphone or tablet is covered by a 12-month warranty. So yeah, it's very easy in the scenario. You would have been able to identify, warranty, be very happy, I know where to go. B, the application guidance, where I will get additional assistance. If a faulty device is returned within 7 days, they receive a new device. If it's returned after 7 days, they will repair the service at, very important, seller's cost. Then they tell us what it covers in terms of the Customer Protection Act, and then the defective devices returned after the 12-month warranty will still be repaired, but for the cost of the customer. So very important, always required. Discuss the following with regards to a contract in terms of IFRS 15, whether the 12-month warranty should be identified as a separate performance obligation. So that indicates, okay, step 2, I know it will be IFRS 15 paragraph 22 that I start with. So I first have to discuss whether it is distinct. So for the interest of time, we did not include the discussion on whether the warranty is a separate performance obligation. I'm just going to jump to the warranty specific section, but in your learning unit 2, the full answer is provided. So from our perspective, it's application guidance, B29, B30, and B31, which actually includes the checklist, if I can call that, of when a warranty is a separate performance obligation. So there you can see if they do not have the option to purchase it separately, it will be in any case an IAS 37 transaction. So continuing on that, we said, okay, the performance obligation, now we're coming to the warranty specifically. Furthermore, IFRS 15 gives specific guidance. If a customer does not have the option to purchase it separately, the entity shall account for the warranty as a provision, unless that promised warranty provides the customer with a service in addition to the assurance. Customers do not have the option to purchase a 12-month warranty separate. So there we know, okay, so now we must move on to, do they get a service in addition to the assurance? And then we go to what does B31 state? Whether the warranty is required by law. Yes, it's required by law. It's stated in the scenario, the Consumer Protection Act. The length, is it longer or shorter? We can see it's only for 12 months. Normally for cellular devices, we would expect them to at least last considerably longer than 12 months. And I think it's evidenced even now when you look at in practice that cell phones are financed over 3 years, for example. So you can see now in relation to the life of the device, 12 months, it's not the full length of the usage of that device. So we can say, oh, so it's short in paragraph B. And then coming to paragraph C, the nature of the task that the entity will perform. They will replace and repair the defective iPhone within 12 months. Thereafter, it's the responsibility of the customer. Therefore, we can conclude it does not provide a service in addition to the assurance. Therefore, the warranty is not a separate performance obligation. So please review this whole IFRS 15 discussion. See if you can develop your own game plan, your game tactic, that when you get a question, you actually know where to start. And the reason I allude to the game plan or the tactic is it will give you a lot of confidence, meaning when you open the question, you read the required, you see, here is a question that I've actually practiced my technique, how I'm going to discuss it. If it's a discussion question or if it's a journal question, you will see you actually start off the question when you go to the scenario already on a positive note. You say, but I can do this. I have done this before. I'm ready with my game plan. I'm going to score a lot of marks. And then, okay, with regards to then the transaction price, that's step 3. Normally, the transaction price is the amount of the consideration. Normally excludes VAT, but for this, of course, you will have to let the question guide you on what it states with regards to VAT, or whether it says ignore VAT. It can include fixed or variable amounts. The standard do provide some guidance as well when it is variable, in the sense that there's refunds, discounts, etc., that you can take into account. And they do actually provide some nice guidance of at initial sale date, you will make an assessment based on historical trends on what is the percentage of customers that would take or make use of a early settlement discount, for example. So if we look at our practical questions, just so that we can also include, of course, that revenue is very important to discuss. When is it a performance obligation, the transaction price? But of course, you must also show us the money. And I mean, that's when the journal comes in. So just to show that it's not only discussion questions, it's journal type questions as well. So in this case, it was 100,000. There's a discount of 5% if they pay within 10 days. They estimate that all of the customers would make use of the early settlement. What does the journal look like? So see, we start off with, they assume that all the customers will make use of the 5% early settlement. We recognize then the remaining revenue, there's our trade receivables. And now that we say, when it comes into practice that all the customers did make use, which in this case they told us they did, we again bank our 95,000, and our trade receivables we just reverse, and our allowance for settlement is also netted off, and then we actually get what we originally assessed. So hopefully it's a nice just journal to illustrate that principle. The next slide is just to remember or to illustrate, of course, the importance of financing components. So you should always be on the lookout for that in any revenue discussion question as well. If it's 12 months or longer, it's already assumed that it does already contain a financing component. So just be aware or ensure that you are able to identify the financing component, of course, and then to be able to either discuss what is the treatment of the financing component, what is the implication on the transaction price, or then with regards to a journal, what is the implication on a transaction price. So I did not include a slide with information of a scenario. It's just the solution, but just to illustrate the principles, time value of money. You've seen this type of calculation for the second time this evening as well. So you should always be very happy if there's time value of money, you have to do a present value calculation. But in practice, it would be that there's time value of money. I need to present value what my revenue amount is, and then trade receivables. And then as the time lapses over time, every year I would then recognize that interest component against trade receivables, that in the end, when the contract is now due, my trade receivable is 10,000. I've recognized my interest income over the 2 years, and there's my bank. So it's a very easy concept, I think, to follow as well. You should be very happy if you get a financing component in a question as well. The fourth step sees the allocation of the transaction price. Of course, to allocate the transaction price, we need to know whether there's 1 or 2 or 3 performance obligations. We need to know what is the transaction price. This is normally given, but you saw there's also some requirements if it is variable, if there's a discount, etc. But then as soon as we know the transaction price, now it's to allocate it to each performance obligation. So please also ensure that you're able to identify the different components with regards to allocating a discount or the consideration that includes variable amounts. And then I'm just going to quickly also just jump into a short example just to illustrate what it means. So we can see the transaction price is 1,000. There's 3 performance obligations, which we can see totals 1,500. So what is step 4 is to say, how do I allocate this 1,000 between my 3 performance obligations? And it's fairly easy. You should be happy if you get it in the test or the exam. We just take, here's our transaction price. We take it over each individual performance obligation, its standalone selling price over the cumulative or total selling price, allocate it, and there's our 1,000. And we have a lot of easy marks available for that principle as well. And then lastly, coming to when is revenue recognized? It's of course either over time or at a point in time. And the important thing is we will always start with whether it's satisfied over time. And if it's not satisfied over time, it's satisfied at a point of time when control over the product or good is transferred. So you would always start with whether it is satisfied, and if you conclude, or satisfied over time, sorry, if you conclude no, then you default back to, okay, but then that's at a point in time on the date when control is transferred. And I see it's now time at the end of the session. There is still, you can see at the bottom, 30 slides on fair value measurement. Sorry for that. It's a tongue twister for me, apparently. But it's quite comprehensive. It's quite a lot because it tried to be as detailed as possible because I could foresee that we're not going to have time to go through that. So hopefully it does add value. You can see it follows the same structure with regards to the proficiency level, the introduction to the standard, examples as well. So I would please just encourage you. You have the slides then with you to revise as well. The recording for those not able to attend. But from my side, and I think this is the end of your financial accounting week, I hope we have been able to hopefully make it financial accounting a bit more better and easier, and that it's not only your favorite subject on a Monday. I almost want to say it's an inside joke for those that were in the meeting already at 5:30, the favorite module on a Monday. But then from my side, thank you very much. Thank you for all the questions as well. If it seems like some of the topics were oversimplified, it is because it can be that simplified if you understand the principles. So I would really encourage you to see if you can understand the how, the why, the when, because a question is just a combination of the different principles. And when you get to a test and you are able to do 10 of the 15 principles right when you already identify them, then of course it gives you a lot of confidence to even attempt and do well in the other 5 as well, because you can just use your knowledge and skill already obtained up until this level as well. Yeah, so from my side, I am done for the evening. I don't know if there's any other questions that you want to ask, but then before you leave, I just want to say good luck with your preparations and for test 2. If you want more assistance, please reach out. We want to help you and to have a successful year. Oh, and one last thing is I'm going to copy the evaluation form in the chat if you would just mind or don't mind filling that in. But thank you very much. I don't know if there's any questions. And if you have, you can please come through.
Thank you, sir.
Yes.
And I just wanted to say thank you on my side.
Okay, great. Then yes is appropriate. I'm glad it helped, and good luck. Thank you for attending.
And also, I would just like to ask, in Monday's class, you mentioned that the lecturers mark the papers that we write. Is that going to be the practice going forward even until exams?
I can tell you, yes, it's a university-wide decision. There's no external markers for any of the colleges anymore now. So all the lecturers are marking this.
Thank you, sir.
Right, so just on that last step of the IFRS 15, why is there
Yes.
no heading in the standard for that? So I tried looking for it. The first 4 I can find, but the 5th one, so the actual recognition.
Okay, let me just see. Just going to open the standard from my side as well.
It will be called satisfaction of performance obligation. Last one, step 5.
Yes. Thank you for that. Yes, you'll see it's actually quite early in the standard. I think it's from paragraph 31.
Yes.
So it doesn't feel like it's a logical flow or the natural fit for where step 5 should be in, but I think they tried to group it where it was the discussion on the performance obligations. But of course, it's only after you've determined the transaction price allocated to the performance or the performance obligations, then when you're satisfied, that is actually then when you recognize the revenue. I don't know if that helps.
Yeah, it does. Thank you.
Thank you for that assist as well. Thanks. If you have a citizen's hand, you can come in.
Okay, I want to know that what do they mean by saying warranty required by law is not a performance obligation in terms of the recognition? Does it mean that the company would not raise a liability?
Yeah, so I'm seeing if I can quickly go to that slide. The question, I don't know how far back to go, but no, that was still part of the assessment of whether the warranty will be a separate performance obligation. So they say if it was not required by law, but you provide the warranty, that might indicate that you are providing a service over and above the assurance that the product will work. But the fact that you are providing the warranty because it's required by law, that does not illustrate that it's a separate performance obligation because you're required to provide that warranty. But if you are providing now the warranty, even though it's not required by law, that might actually indicate that, yes, you are providing an additional service, which could then be a separate performance obligation.
But in both the circumstances, are we raising a liability for the warranty?
In this instance, if the performance obligation is not, the warranty is not a separate performance obligation, then let me think about that. I understand your question. So you would say if it's a separate performance obligation or not, whether we would raise it as a performance a provision.
Yes.
Is that your question?
Yes, that's my question. Because when there is when it is a performance obligation, we are raising a liability on that day, which is a warranty. Ne? the provision for the warranty. So now I'm asking you, if it is required by law, are we doing the same thing?
Yes, let me get back to you on that specific one if you don't mind.
Okay, thank you.
Thanks. I'll just make a note for that. Thanks.
Yeah, and again, I also don't understand what this warranty required by law. Is it like when I buy a phone, there is that 7 days of saying that if it doesn't work, then you can return it back? Is it that one or what?
Yes, we will have to provide you with detail in the scenario as well. But in South Africa, the normal one that will be of default, of course, is that there's a Consumer Protection Act that says, but you should be allowed, or you must allow the customer to actually return or replace the device within 7 days, but then or within 30 days, then you don't need to replace, but you must repair, etc. But of course, some retailers do provide a longer period, or they might have to say, but yes, you can return it, but you won't get a refund. You can only exchange it. But I mean, for your practical purposes for a question, we would have to provide you with the specific information that you're able to answer the question.
Okay, thank you.
But yes, I'll get back to you on that. Sorry for that.
Oh.